Hi, everyone. Thanks for coming along today. So in the interest of getting through this, I'm going to start our Queensland and Northern Territory market update and outlook. What we're going to start with today, though, is a broader national economic overview, just to set the scene of what we're seeing across the country at the moment with the broader economy. And then we'll go into the housing market and rental market update for both Queensland and Northern Territory. As we go through, this is being recorded, so this will be made available to you after the presentation. And there are opportunities for questions if you just put them into the Q&A or the chat function at the bottom of the Zoom. But let's kick off. So to start with, this chart here looks at economic growth. That black dotted line is the 30-year average rate of economic growth. The black line is what's happened over the past year. So you can see that economic growth is less than half the 30-year average, and it's trended much lower over the last 18 months or so. So economic growth has just been 1.1%. Outside of the pandemic, that is the weakest annual growth since March 1992. So the economy is very weak at the moment. On a per capita basis, GDP has fallen by 1.3% over the past year. So really highlights that it is the strong rate of population growth, which is overall lifting demand, which is growing the economy at the moment. We've seen per capita GDP growth fall for 4 consecutive quarters. In data which goes all the way back to 1973, we've never seen that previously. So the economy is very weak at the moment. We can also see this playing out when we look at the household saving ratio and household consumption. Household consumption accounts for about half of economic growth, and you can see it's less than half of its 30-year average at 1.3%. So households have really tightened their belts and reduced their spending. Households are also saving a lot less than they were previously. The saving ratio is down to 0.9%. It was a little bit lower a couple of quarters ago, but you'd have to go back to before the global financial crisis to see the saving ratio as low as it is at the moment. So we're still saving more than we're spending, but the amount we're saving has reduced dramatically, which again is a response to the higher interest rate environment we're sitting in at the moment. If we look at inflation, inflation over the last quarter, both headline inflation, which is everything, and underlying inflation, which takes out some of the more volatile items, came in at 1%, which was a lift from the previous quarter and was much stronger than people were anticipating. Now, on an annual basis, inflation is still falling. You can see it's 3.6% for headline, 4% for underlying, but it is still outside of the Reserve Bank's target range of 2 to 3%. Now, we're getting close to that target range, but I expect that it's going to be difficult to see it actually dip below that 3% range, and I don't think that's going to happen until the second half of next year. So inflation is still too high. At the moment, it doesn't look like the Reserve Bank is going to lift interest rates further, but if the next quarter of inflation is stronger than expected, then the likelihood of an interest rate increase rises significantly. If we look at the things that are driving inflation, you can see that services inflation is much stronger than goods inflation. And it's more of the non-discretionary items where we're seeing the stronger inflation. So insurance, you don't have to pay insurance, but it makes sense to. And you can see insurance costs are up 8.2% over the past year. Why are they up so much? The cost of building a new home has gone up so much. So, the replacement cost of insuring your house has gone up a lot. There's obviously more regular natural disasters and things happening, big storms with climate change, and that is driving up insurance costs as well. Education costs are up a lot because they are indexed to inflation. Inflation's been high, but also you've got a lot of demand for education services at the moment. You can see housing inflation has been quite strong, mostly driven by rents at the moment. And alcohol and tobacco has seen strong inflation as well because there's an excise on alcohol and tobacco every 6 months, and it is indexed to inflation. So again, higher inflation means larger increases in alcohol and tobacco. So whilst goods inflation is slowing, goods tend to be more discretionary items. Some of the services where we're seeing strong inflation are very much non-discretionary items. So if we have a look at the cash rate's at 4.35%. It's been there since November of last year, so it's been on hold for about 6 months now. It is the highest interest rates we've had in 12 years. If we look at the expectations as to where interest rates are going to go, which is the chart on the right, there's no longer an expectation that interest rates will increase, but there's no expectation of cuts until sort of mid next year. If I was to bet on this, I would say that we're probably looking at an interest rate cut at the earliest around February or March of next year. And of course, if you went back a couple of months, it was looking like interest rates were going to be cut sort of September, October this year. So that has pushed out expectations a good 6 months, which will be interesting to see how mortgagees respond to that, because I think a lot of people were buying and setting themselves up in the market with the view that interest rates were going to be coming down this year. Now it looks more likely that it's next year. The labour market has been a real strong point of the economy. You can see on the left, the black line, the unemployment rate has trended higher, but it's still very low at 4%. So it's been under 4% for about the last 2.5 years. Before then, you'd have to go back to before 2008 to see an unemployment rate below 5%. So that shows you how strong the labour market has been. Employment participation's pretty much at record highs rather. But there are signs of a weakening labour market, with the number of people employed slowing. Now it's still growing and it's above that 30-year average, but there has been a slowdown in its growth. If we look in Queensland, the unemployment rate's also 4%. Job creation over the last year was 3.6%, with full-time employment up 2.6% and part-time employment up 5.8%. In the Northern Territory, the unemployment rate's 4.1%, a 0.7% increase in jobs over the year. Full-time jobs are up 2%. Part-time jobs have fallen by 3.9% over that period of time. And if we look at a national level, you can see that underemployment and underutilization. So underemployment is when someone is employed but would like to have more hours. So that could be someone that's part-time that wants to be full-time, or it could be someone that's got 20 hours that wants to have 30 hours a week. And underutilization is the combination of underemployment and unemployment. Both are trending higher, but both are fairly low compared to recent levels. In Queensland, the underemployment rate is 7.2%. The underutilization rate is 10.9%. In Northern Territory, the underemployment rate is 4%. The underutilization rate is 7.8%. On the right, you can see that, again, another sign that the labour market's weakening a little bit is fewer hours are being worked, or the growth in hours worked is slowing, up only 0.6% over the past year. And in Queensland, it rose by 1%. In Northern Territory, it was down 0.3% over the past year. And then if we look at online job advertisements, now there's still a lot of jobs being advertised across the country, but the number is down 21% from its recent high. In the Northern Territory, you can see there's been a 4.2% fall in job ads over the past year. In Queensland, a 9.5% fall. As the labour market weakens, as the unemployment rate drifts higher, I think a lot of businesses will reassess their employment intentions. As people leave, they may not replace those roles, or they replace them slower, and they'll be looking at the jobs that they have open at the moment and reassess whether they actually need to fill those roles or not. So the tight labour market we've had, though, has pushed wages higher. So wage growth peaked in the December quarter at 4.2%. It dropped on an annual basis slightly in the March quarter at 4.1%. But you have to go back to 2009 to see the wages growing as fast as they are at the moment. The good news is that wage growth is stronger than inflation. So households are getting real income increases at the moment, something that hasn't happened over the past 3 years or so. I think we'll continue to see wage growth slow, but I think it's going to continue to be stronger than inflation. So those real wage increases will continue. Which then brings us to the lending environment. So over the past year, new mortgage lending has increased by 24.5%. Refinance lending has fallen by 16.3%. New lending, rebounding really strongly. Refinancing has slowed right off because at the start of last year was the peak of the people coming off fixed rate mortgages from the pandemic. Most were going to variable instead of fixing again, but also interest rates haven't been changing for the last 6 months. So not as many people have been shopping around for a better deal. In terms of the components of new lending on the right there, you can see that subsequent buyer lending is overwhelmingly the largest share, followed by investors and then first home buyers. But if we look at how much lending's increased, new lending to investors is up 36% from a year ago. First home buyer lending's up 18.6%, and lending to subsequent buyers is up 18.8%. In Queensland, investor lending's up 46% over the year. First home buyer lending's up 23%. Subsequent buyer lending's up 18%. And in the Northern Territory, investor lending's up 74%. First home buyer lending's up 33%. And subsequent buyer lending's only marginally higher, up 0.2%. It's a bit of a head scratcher why there hasn't been a stronger rebound in subsequent buyer lending when you look at all the sales activity. But a big part of this is that the downsizer market has been so active. And if you're downsizing, you may not need finance at all. Or if you're moving from a more expensive property to a cheaper property, the amount you have to borrow reduces significantly. So that's probably the reason why subsequent buyer lending has seen a much more muted growth. Moving on to housing material costs. So we've seen through the pandemic, a really large escalation in these costs. So you've got input costs, which are the materials, and you can see them on the right. So they're up about 33% since the beginning of the pandemic. The escalation in those costs is slowing. It's only 1.3% over the past year. Then you've got the output costs, which is the earthworks and the construction of the physical house or other residential, which is units. So the output costs for houses are up about 44% since the beginning of the pandemic. And you can see they're up 4.3% over the past year. For other residential, it's only up about 22% since the beginning of the pandemic, but it has increased by 7% over the past year. What does this all mean? Well, it means that the cost of a new house has increased much more than the cost of an existing house. So the gap in pricing between new and existing is large, and people are preferencing buying an existing property as opposed to a new property, because there is always a price premium, but that price premium for new is much larger than it has been historically. But unfortunately, we need to be building more housing. So dwelling approvals are trending lower. In fact, over the last 12 months, they've pretty much been at decade low levels. And there's a few reasons for this. Firstly, interest rates are the highest they've been in 12 years. So firstly, construction and developer finance costs are extremely high, but also because you've got that material costs have gone up and construction costs have gone up so much, the end cost of the product is much higher. So developers are finding it a lot harder to get the pre-sales they need to go ahead and start constructing new housing, given those higher costs and those reduced margins. In Queensland, there's been about 32,000 approvals over the past year, which is 13.3% down from a year ago. In Northern Territory, we don't get a lot of new housing, but there was 387 approvals over the past year, which is 37% lower than the previous year. And you can also see this playing out. If we're not getting approvals, we're not getting commencements. So commencements are also down around decade lows. In Queensland, they're down 5% from a year ago, commencements. And the number of dwellings under construction is down 7%. In the Northern Territory, commencements are down 33% from a year ago, and the number of dwellings under construction is down 31.5%. Now, there's still a relatively high number of dwellings under construction, but that pipeline is reducing. And the reason why we're still seeing an elevated level of new housing construction is that everything is taking longer to build. Which then brings us to population growth. So over the past year, the population of Australia has increased by about 650,000 people, mainly through net overseas migration. In fact, natural increase, which is births minus deaths, was the lowest it's been any time since the beginning of the 1980s. In Queensland, the population over the past year increased by 2.6%. We had a natural increase of just under 22,000 people. We had net overseas migration of 88,000 people, which was just slightly lower than the record high the previous quarter, and net interstate migration of 31,500 people. Queensland, along with Western Australia, were the only two states which had positive net interstate migration. In the Northern Territory, population has increased by 1% over the past year. Natural increase was a record low of 2,071. Net overseas migration was just slightly lower than a record high at 4,272. And net overseas migration saw 3,957 people leave the Northern Territory, which was the largest outflow on record. So where do we think the economy is headed over the next 12 months? What do we think is going to happen? So on the right here is the latest forecast table from the Reserve Bank as to what they think is going to happen. Some of the highlights, they think that economic growth will pick up late this year and continue next year, but still be well below the long-term average level. The productivity performance is expected to continue to be quite weak, and the unemployment rate will drift higher over the coming period. So where do we think things are? We've only got economic growth data up until March. We expect further weakness in the June quarter. And then, like the Reserve Bank is forecasting, a bit of a moderate improvement in economic growth over the second half of this year. Why? The interest rate increases that we've had, the impact of those starts to fade the longer you go without moving interest rates. We also get tax cuts from the middle of this year, which have been broadened, so more households will get tax cuts. And some modelling suggests that those tax cuts are the equivalent of, anywhere between 2 and 4 interest rate cuts. So they're certainly going to be stimulatory. You've also got the fact that inflation is likely to continue to moderate, and that will help households improve their spending as well. We do expect inflation to moderate further, but it's still likely to remain outside of the Reserve Bank's target range at the end of this year. It's not expected to come back until the second half of next year. As a result of that, though, interest rates look likely to remain on hold into next year. As I said, I would be betting February, March at this stage is the most likely time for an interest rate cut. The labour market, we do expect that it's going to continue to weaken. Unemployment will drift higher. Some of those labour shortages we have will wane, but also as the economy continues to be weak, businesses will reassess their hiring intentions and slow down their hiring or cancel some of the open jobs they have. Wage growth, as I said, has likely peaked, but we do expect that with inflation coming down at a faster pace than wages, real wage increases are expected to increase over the coming year or continue. Housing construction, unfortunately, we need to be building a lot more housing. The federal government's set a goal of 1.2 million new homes over the next 5 financial years. So, that starts from next month. But new housing construction looks likely to be even lower this year than it was last year, right when we need more housing. And the population growth rate looks like it peaked in the September quarter, but it's still extremely high. Even though the government is talking about slowing population growth, there's a lot more work to do, and it's still well above long-term average levels. In terms of that population growth, who's driving it? At the moment, the largest source of population growth from overseas is temporary students coming here on a visa. So if you're here temporarily on a visa studying, you're not likely to buy a property, you're likely to be renting. And this is putting a lot more pressure on the rental market right across the major capital cities. And that's likely to persist over the coming period. So from there, let's have a look at what's happening in the established housing market. So in Brisbane, you can see here that over the last 3 months, prices are up 2.4%. Logan, Beaudesert and Ipswich, along with Brisbane's eastern suburbs, which is out around Wynnum, Cleveland, those areas, has seen the strongest growth in prices. And then in regional Queensland, price growth is 1.7%. Townsville has actually seen the strongest price growth, followed by central Queensland. But everywhere except for outback Queensland has seen prices rise over the past 3 months. That rate of growth has been decelerating over the last little while. If we look over the last 12 months, prices in Brisbane are up about 13.7%. In regional Queensland, they're up 9.9%, basically 10%. Again, Logan, Beaudesert and Ipswich seeing the strongest price growth, Townsville seeing the strongest price growth regionally, but everywhere seeing quite strong price increases at the moment, which really speaks to the fact that there is strong demand for housing across the state. Some context. So prices in Brisbane are up about 14%. Prices in Adelaide are up a similar amount. Prices in Perth are up 20% over the past year. Prices in Sydney are up 8%, and prices in Melbourne are up about 1% over that same period. So that gives you some context across the major capital cities. If we look at the performance of houses and units, interestingly, in Brisbane, unit prices have actually grown at a faster pace than house prices, only marginally though. And in regional Queensland, the reverse is true. But where's some of the standouts? You can see unit prices in Logan, Beaudesert and Ipswich have increased substantially. The best performing market for house prices in Brisbane's been Ipswich. Townsville house prices are up 18.8% over the past year. So again, the outback is the only region where we're seeing house prices and unit prices fall. So really strong conditions right throughout Queensland at the moment. If we look at the past 5 and 10 years, so over the past 5 years, prices in Brisbane were up 73%. They're up 75.1% in regional Queensland. And then over the past 10 years, 93.4% increase in house price in prices in Brisbane, 94.2% increase in regional Queensland. The best performing market over the past decade has been the Gold Coast, 131.6% price growth, and the Sunny Coast, 127.6% increase in prices over that period. A lot of areas of Brisbane, down you can see from Moreton Bay South below, have seen house prices double over the last decade. So a really strong period for price growth, although you will note that most of the price growth from the last decade has happened in the past 5 years, which speaks to what's happened through the pandemic. If we look in the Northern Territory, you can see here that over the last year, prices in Darwin are up 1.4%. Prices outside of Darwin are down 4.9%. So we are starting to see an acceleration of that annual price growth in Darwin, mainly driven by houses where prices are up 2.2%, whereas unit prices are down 0.7%. So yeah, some price growth returning in Darwin, but the rate of price growth has been much more moderate than what we've seen in most other capital cities. It's slightly stronger growth than Melbourne. It's stronger growth than what we're seeing in Hobart, where prices have fallen, but every other capital city is seeing stronger increases over the last 12 months. Now, having a look in Queensland at house and unit prices and the percentage difference, you can see that some of the inner city areas, the Brisbane City Council areas, are seeing very strong, high prices for houses, and similarly the Golden Sunshine Coast. And that differential between house and unit prices is really widening quite significantly, which talks to the fact that we need to get more medium density into some of these established suburbs and more high density where it is appropriate to give people the opportunity to live in these more desirable areas. As someone that lives in Queensland, I can definitely say, though, we also need the infrastructure in place to support more people and higher density in some of these suburbs too. So let's have a look at the supply of stock for sale. So we're actually starting to see a little bit of an increase in the number of new listings. You can see for most of this year, new listings in Brisbane have been higher than they were last year. They were 17% higher in May than a year ago, and they were slightly higher than the average for each May from 2018 to 2022. And you can see on the right how that plays out. But most parts of Brisbane and most parts of Queensland, for that matter, are seeing a higher number of new listings than we were seeing a year ago. Total listings are still very low on a historic basis. They're down 3.5% from a year ago. That says plus 36.5%. It should actually say minus 36.5%. Apologies for that. So there's not a lot of stock available for sale. So yes, there's a few more new listings coming onto the market, but the overall amount of stock available for sale is extremely low right across Queensland at the moment. You can see places like Darling Downs, Maranoa has 61.3% fewer properties on the market than it has on average over the past 5 years, 56% fewer in Townsville, 54% fewer in Cairns, 46% fewer in Ipswich. There's not a lot of choice out there in the market for people looking to buy, and people are basically hanging out for those new listings to come to the market. If we look in Darwin, new listings in Darwin are up 15.5% from a year ago. Total listings are up 0.8% and pretty much bang on that 5-year average level. But there is quite a lot of stock coming to market in Darwin at the moment. Which then brings us to sales volumes. Even though we've seen a marginal increase in, we've seen a decline in stock for sale, we've seen an increase in sales. So sales volumes in May this year were up 5.4% in Brisbane compared to last year. Brisbane's eastern suburbs and Brisbane's northern suburbs have seen an increase in sales, the biggest increases. Regionally, a very different story. Sales volumes are lower than they were a year ago, with Mackay, Isaac, Whitsundays the one exception, where sales volumes are up 17.5% compared to a year ago. If we look in Darwin, now we're talking about low volumes in Darwin, obviously, but sales volumes have increased significantly compared to last year in Darwin. In regional Northern Territory, we can see that volumes are hovering around similar levels to what they were 12 months ago. That then brings us to our measure of demand, which we measure by looking at the number of inquiries per listing. So in Brisbane at the moment, inquiries per listing is higher than it was a year ago, 23.3. So it says that there's a lot of people out there looking to buy. Have a look at the number of inquiries per listing we were typically getting before the pandemic. You were talking about 6, 7 inquiries per listing in Brisbane. You were talking about 2 to 3 in regional Queensland. So the level of demand out there for property in Queensland is really quite strong at the moment. Logan Bow Desert and Brisbane's northern suburbs seeing the highest level of inquiry per listing. Regionally, not surprisingly, the Gold Coast and Sunshine Coast seeing the highest level. But Townsville, you can see inquiries per listing have more than doubled over the past 12 months in that market. If we look in Northern Territory, obviously overall inquiry is quite a lot lower, but in Darwin, it's up 17% from a year ago. And in regional Northern Territory, it's up 14.5% from where it was a year ago. So again, more demand for property in the Northern Territory than what we were seeing 12 months ago. And then if we look at the days on site, so in Brisbane at the moment, the typical property is taking 33 days to sell. A year ago, it was 39 days. And if we look at the 5-year average to May, it was 54 days. So properties are moving very quickly. And we're finding the vast majority of properties that sell in Brisbane at the moment are properties that have been on the market for less than 2 months. Once you get past that 2-month period, properties hang around on the market for a very long period of time. Some of the highlights: Brisbane's western suburbs, 25 days at the moment. The Gold Coast, 38 days. You can see 25 days in the southern suburbs as well. So properties are selling quickly. If we look in Northern Territory, you can see in Darwin, days on site's increased a little bit relative to a year ago, 57 versus 68, but days on site is lower than the 5-year average. In regional Northern Territory, it's increased from 96 days to 132 days and is well above that 5-year average level. So broadly, in terms of the market at the moment, we've seen really strong price growth over recent decades. Maybe not so much in Darwin. It's a bit more of a volatile market, but certainly in Brisbane and in Queensland. And I think there's been 4 big drivers of that. Interest rates. They've fallen from 18% at the start of the 90s to basically nothing. They're a little bit higher now. As interest rates have fallen, borrowing capacities have increased quite dramatically. Credit has become a lot easier to access, or at least it did from the 90s and 2000s right up until we had the global financial crisis. Credit is now more difficult to get. Go and take out a loan. The bank wants to know, streaming services, holidays, private school fees. Are you planning to have kids? It's quite intrusive. I don't think that's going to go away. But also, you've got APRA, the banking regulator, who've brought in credit growth limits. They've changed serviceability buffers. And again, I don't think that's likely to change. Employment participation I talked about before was at record high levels. a lot of this has been driven by more women joining the workforce. So as more women have come into the workforce, household incomes have increased, and like the reduction in interest rates, that's increased borrowing capacities and allowed people to spend more on housing. That's probably not going to increase dramatically from where we are, and it's certainly not going to be as big of a boost going forward. Migration is still really strong, and it does drive a lot of demand for housing. It's now becoming a bit more of there's a bit more conjecture around the right rate of migration for Australia. So I think if we look at putting migration to one side, if we look at those other three factors, they're unlikely to be as big of a driver of price growth as what we've seen over recent decades. Now, this isn't to say prices won't rise, but I think we can't expect property prices to rise as rapidly going forward as they have over recent decades. But if we look right now, we're seeing really strong demand for housing, which to me is quite surprising given where interest rates are, highest they've been in 12 years, and how quickly they increased over that period of time. I mean, borrowing capacities have fallen about 35%, but we're still seeing really strong demand for housing. We have seen a slight increase in the amount of stock for sale, but we've also seen an acceleration in price growth, and we're about to update our forecasts, but we're revising higher our expectations for price growth this year, both in Brisbane and in Darwin, on the back of how strong the market has been so far and how high that level of demand is. As the supply of new listings coming to the market increases, that means that people will have a little bit more choice and there's less fear of missing out. So vendors need to be really realistic on prices because buyers are going to have the ability to be a bit more selective than they have for a while. We've still got very high costs of new housing. When I speak to property developers, I say to them, the thing you want is strong price growth in the existing market, which is happening in Queensland, and you want a low volume of stock in the existing market, because if that happens, the gap between new and existing prices narrows, but also if people can't find what they want in the established market, it may actually force them to have to go and buy something brand new. Now, there still is a premium there, but that premium is nowhere near as large as what we saw maybe 12 or 18 months ago. But it's still going to mean that it's hard to deliver new housing, given that that price premium is still there. We need more infill housing, mostly medium and high density, but there are a lot of political and financial hurdles that need to be overcome to deliver that housing. And that high cost of renting, which we're about to get into, is likely to see more people that have the capacity to do so to exit the rental market and purchase their first homes. I think that will be a feature of the next 12 months. So let's have a look at what's happening in the rental market. So if we look in Brisbane, over the past 3 months, you can see house rents have actually grown at a faster pace than unit rents. And you can see that, rents are quite high right across the board. If we look at Brisbane rents versus regional Queensland rents have increased at a slightly faster pace over the past year. You're looking at $620 a week for rent in Brisbane, $610 in regional Queensland. Mackay Isaac with Sundays has seen the strongest rental growth. And probably a little bit surprising is where we've seen the strongest rental growth in Brisbane. It hasn't been in those inner city areas where you'd sort of intuitively think it's the case. It's Logan Bow Desert and Ipswich where we've seen the strongest rental growth. I think this really speaks to the fact that people are having to rent in locations maybe further away than where they'd ideally like to be renting because the cost of renting has got so high. It's not just a Brisbane or a Queensland phenomenon. We're seeing this elsewhere as well, that, the inner city areas are actually underperforming quite substantially compared to areas further away. And that really comes down to the high cost of renting in those markets. If we look at rents for houses versus units, so house rents were up 10.2% over the past year in Brisbane, 6.8% in regional Queensland. And unit rents, it's the reverse in regional and capital cities. So 6.8% growth for rents in Brisbane for units, 13.5% increase for unit rents regionally. 20% increase in Mackay Isaac with Sundays, 15.5% increase in unit rents in Cairns, 15% increase in Logan Bow Desert unit rents. Now, if we look over the past 5 and 10 years, you can see that most of the rental growth that's happened over the decade has come in the last 5 years. 57% increase in rents over the last 5 years in Brisbane compared to 61% over the decade, and 62.7% increase in rents over the past 5 years in regional Queensland compared to a 74% increase over the decade. Some of the standouts over the decade: Wide Bay, house rents are up 89%. Rents for houses on the Gold Coast are up 80%. You can see, though, 58% of that 80% has come in the last 5 years. In Wide Bay, 72% growth in the last 5 years, only 90% over the last decade. So most of the rental growth has happened very recently, mainly through the pandemic. If we look at Darwin, so the median rent in Darwin now is $600 a week. In regional Northern Territory, it's $495 a week. Rental growth has been much more muted in Northern Territory, 4.3% higher over the year in Darwin, 3.1% higher over the year in Northern Territory, outside of Darwin. So rents are definitely high. I mean, you're paying similar to what you're paying in Brisbane, but you're not seeing that same level of growth. If we look at rental returns, so even though rental growth is still strong, we're now seeing prices rise at a faster pace than rents, and that's pushing rental yields lower. But rental yields are still reasonably attractive, especially for units, for example, 5.3% in Brisbane, 5.5% in regional areas of Queensland. So, that's definitely attracting some investor cash in. The returns are good, but you're also still seeing that capital growth as well. In the Northern Territory, rental yields are the highest in the country. You can see 6.5% for a house in regional Northern Territory, 6% in Darwin, 7.3% for a unit. It's definitely an investor market in Northern Territory if you're a yield-based investor. You're not getting large increases in prices at the moment, and you're not getting large increases in rents, but the rental returns are very strong. Which then brings us to rental supply. So we've actually seen a bit of an increase in new rental listings in Brisbane over the past month, and they're up 7% compared to a year ago. They are below that 5-year average, but only marginally so. But news only telling you about the flow of stock coming onto the market now. The total number of properties on the market is still extremely low. Yes, it's higher than a year ago, but it's down 21% compared to the 5-year average to 2022. So there's not a lot of rental stock available in the market at the moment. In Darwin, a similar story, very little rental stock becoming available. New listings are up 1.2%. Total listings are up 4% from a year ago, but on a historic basis are still at extremely low levels. So it's still very tough for renters out there in the market. The number of inquiries per rental listing is down in Brisbane. It's slightly higher in regional Queensland. Again, look, Logan Bow Desert seeing the highest number of inquiries per listing, Moreton Bay South, whereas, inner city areas, you're seeing relatively lower inquiries per listing. But again, I'd point you to what typical rental inquiry per listing was before the pandemic. You were looking at about, 15 inquiries. We're now looking at 27 and 23, depending on if you're in Brisbane or regional Queensland. So rental demand is still very strong. In the Northern Territory, slightly fewer inquiries per listing than a year ago in Darwin, and slightly more in regional Northern Territory, but again, elevated levels of inquiry per listing in both of those. Rental vacancy rates at very low levels. Look, before the pandemic, you were looking at a vacancy rate of about 2.4% anywhere in Queensland. You're now looking at 1.1% in Brisbane, 1.2% in regional Queensland. The market's tight. And in Northern Territory, vacancy rates are somewhat higher, but you can see they're trending lower at the moment, and they're significantly lower in regional Northern Territory than they were 12 months ago. And properties aren't taking very long to lease. In Brisbane, 19 days. The 5-year average is 24 days. And if we look in Darwin, 24 days last year, 22 days this year, 37 days in regional Northern Territory a year ago, 30 days this year. So, still a lot of demand for rental accommodation. And one of the big problems is we're not getting additional supply coming online. If you think about what, dwelling construction is extremely low. If you think about, 10, 15 years ago when a lot of new dwellings were being built, a lot of that stock was being sold to investors. So a lot of that new stock became rental accommodation. Look at what's being built today. A lot of it's targeted at, downsizers or very much an owner-occupier product. So you're getting fewer apartments in particular being built, but of those apartments that are being built, fewer of them are becoming available for rent. So we're not growing that rental pool like we were, say, 10 years ago. And that's why it's such a challenging rental market at the moment. So where do we think the rental market's going from here? There's several factors that have led to a climb in rental prices. Household sizes reduced significantly through the pandemic. If you've got a reduced household size, you've got more demand for households. Now that has reversed a little bit, but it has actually flattened off and it hasn't returned to pre-pandemic levels. We've got very low levels of new housing construction, labour cost shortages, financing challenges. And at the same time, we've got rapid population growth, mostly from migration, mostly from students here temporarily, at least initially, and they need rental accommodation. Rents have increased rapidly over the past year, but what the challenge now is that people just aren't able to afford to pay the price that people are seeking for rental accommodation. We do think that rents are going to continue to rise, but that capacity to pay the rent is likely to see the rate of rental growth slow relative to recent years. And how do people respond? People will choose to rent in less ideal locations, and we kind of mentioned that the areas where you think rental demand would be strongest is not necessarily where it is. People go to smaller properties. So if you're in a house, you go to a smaller house or you go to an apartment. And increasingly, we're seeing a lot of people shift back into share housing. Again, probably not out of want, more out of necessity, that people just can't afford the rent by themselves and need to go back into share housing. So how do we address what's happening in the rental market on the supply side? Obviously, we need to be building more housing than we are, but even if we fixed everything that was problematic about delivering housing, it'd still take 3 years if we fixed everything today for that to show up. So it's not a quick solution. The quickest solution is to get more people investing in residential property and making those properties available for rent. The other solution on the demand side of things is lowering the rates of migration, which the government is talking about doing, but it's really difficult to implement that. Increasing Commonwealth rental assistance. Now, the federal government's done that in each of the last 2 budgets, but that was after 20 years of basically not adjusting it at all. So there's probably more to do there. Or the other thing is you can encourage more people to become first home buyers. If you're becoming a first home buyer, you're not always, but often exiting a rental property and you're freeing up that rental property for someone else that needs it. And I think if we look over the next 12 months, we expect that rents are going to continue to increase. That will encourage more investors into the market, particularly in a place like Queensland where prices are also rising. And I think that's going to encourage more people that are renting, that have the capacity to do so, to exit the market and make a purchase, because they're going to want that certainty that comes from owning your own home, and knowing that you won't be evicted, knowing that you're not going to get slugged with a 20% increase in rents. I think people will pay a premium to have that certainty. So that gives you an idea of where things are now. I'm going to stop sharing my screen and I'm going to start answering some of the questions that you've sent through. Please send through any more that you have now and we'll try and answer them. I've got a question here from Carolyn. Is there any way this data can be drilled down further? For example, the Mackay Isaac with Sundays region is massive and the demand in Airlie Beach would be completely different to the demand in Dysart. We do have the ability to drill down into lower levels, Carolyn. It's just a bit hard to get really specific in a presentation like this that's for the whole state, but there's definitely information available at smaller areas. So I'd encourage you to talk to your account partner and they can help you with some of that information. That's the only question we have at the moment. Please don't be shy. If you've got any others, I'll give you a minute if anyone wants to write. Daniel's asked, can we receive these slides that were produced today? So we're recording this, and I believe it will be made available to anyone that attended. Any other questions? If not, thank you very much. Hopefully this was really valuable for you today, and good luck for the rest of the year. And I hope the market's kind to you. But thanks. Oh, there's one more in Q&A. What would be a great way to get more first home buyers taking action? Reduce stamp duty or more subsidy to properties at 800,000? Well, both. I think that what with the stamp duty waivers that the state government have announced, and obviously the opposition have announced, will help. They basically hadn't been adjusted for about 15 years. But those stamp duty waivers, now what they do basically is increase borrowing capacity. So they do tend to push up prices. There is quite a lot of stuff out there to help first home buyers. There's a shared equity scheme that the federal government has, and they've got a few different versions of that as well. But people I'm not sure if they're not aware of it, or they're not willing to give up some of the profits. But maybe more awareness of those schemes would help. Obviously, the big thing that would help most is more supply. If you've got more supply, then prices won't rise as rapidly. But reduced stamp duty will obviously help more first home buyers get into the market. The challenge that I see with that is it kind of kicks the can down the road, because next time you have to give even a bigger subsidy to help first home buyers into the market. I've got a question from Mehmet. If you had $1 million, would you invest in resi or commercial? Good question. I mean, I'm much more of a resi person myself, but look, the industrial market is still really strong, and I think there's some really good opportunities still in industrial investing. If I was to invest in resi, a bit of a counter-cyclical move at the moment, but I would think about Melbourne, because prices in Melbourne are extremely cheap compared to the other capital cities at the moment. An anonymous question: do you expect any cash rate increases? Such low stock levels on the Gold Coast is driving a hot market, and can only imagine a reduction will send the market wild again. Look, there is a risk of cash rate increasing again. It will all be dependent on the next quarter of inflation data. If that comes in stronger than expected, and it means that the Reserve Bank thinks it will take longer to get inflation back into the target range, then we would probably see another interest rate increase. But it's certainly not my base case at the moment, but we'll wait and see what happens when that data comes out. We then got a question from Kathy. Thanks, Cameron. Downsize a superannuation contribution scheme could help release more stock to the market, yet the listed prices are more for upgraders. I think that's more of a comment than anything else, but yeah, certainly. Look, I think we need to be doing more to get people to downsize. We're at REA big advocates of moving away from stamp duty and moving towards land tax. There has to be a way to get people out of these big houses that they no longer need, and to free them up for people that do need them. But part of this is you actually need stock for people to downsize into. A lot of people live in areas where property prices are very high. There's not that smaller stock. There's not medium density or townhouses or things like that for them to downsize into. So people don't downsize. Plus, they know that house prices, because of the land component, generally rise faster than unit prices. People try to stay in their houses as long as they possibly can, because they're going to get a better tax-free return for when they sell with the higher price. Stock for downsize is also, yeah, that's essentially what we're talking about. All right. Thank you very much for coming today. I hope that was useful for you. And as I said a few minutes ago, good luck for the rest of the year. Thanks very much.